Let's get to the options activity because that was exploding too. Brian Sutlin's got that. Brian?
Yeah, it does feel like the short squeeze. Call volume trading 2 times average daily volume, so people just panicking to the upside. Then we saw a very quick reversal, but before that reversal into the close happened, we saw about roughly 3,000 calls being bought that expire in 2 days. The $46 strike, paying about $1.70, break even $47.70. I don't know if we get through there by Thursday, but obviously massive short covering using calls to the upside.
Hi everyone, welcome to Clone Compounding, where our mission is to learn from others in order to achieve financial independence.
Carvana, the online used car retailer company, is up over 700% so far this year. Over the 2 years, it lost over 98% of its value. In this video, let's look at Carvana stock and whether it is possibly the greatest turnaround story of our times or one of the riskiest bets ever. We will be looking at the bull and bear case for Carvana. Carvana, the company. Carvana was founded nearly 11 years ago by Ernest Garcia III, who is the son of a billionaire who owned the used car business Drive Time. Founded in Tempe, Arizona, Carvana went public in 2017. Share prices touched all-time highs of $360 per share. Notable institutional investors include Morgan Stanley and Vanguard Group, etc. The bull case. 3 reasons. Number 3. The short squeeze. Looking at the price chart going back a few years show Carvana trading at $350 a share. The stock tumbled down like a black diamond, ski slope, and along the way, the shorts have pressed their bets. More recently the stock is moving higher in a short squeeze, something like what we saw in GameStop and AMC theaters a few years back. It's up nearly 700% year to date. The question is, how long will the gamma squeeze continue on this stock, and can it get its financial house in order? If it does that, then the squeeze will only continue. With 49% of the float sold short, this squeeze could have more legs. If you are enjoying this video, please smash that like button so others can find this video as well, and make sure to subscribe to receive next videos. Number 2. Lower than expected inflation. June 2023 inflation numbers came out lower than expected, and that has given an additional reason for Carvana stock to move higher. Numbers show inflation cooling faster than expected. Higher interest rates are a headwind both for Carvana directly and for its customers. The company has nearly $8 billion in debt, which is hampering its recovery and its ability to turn a profit, and higher rates also make it more expensive for customers to finance cars. While the Federal Reserve still expects to raise baseline interest rates by another 50 basis points this year, falling inflation could change that forecast and make it likely that interest rates are close to their peak if not already there. Number 1. Becoming Ebitda profitable. Carvana management has been working hard to reduce costs, narrow losses, and increase profits per vehicle. It recently shared that it expects to achieve positive adjusted earnings during the second quarter of this year, earlier than previously stated. It is prioritizing profitability over growth. CEO Ernie Garcia said, "The first quarter was a big step in the right direction and there are more steps to come. Given our strong start to the year, we expect to achieve positive adjusted EBITDA in Q2 2023. It is clear our strategy and execution are working, as evidenced by our 61% increase in gross profit per unit, the best first quarter GPU in company history." This might be why Carvana's insiders bought 10.3 million shares over the past 12 months while only selling about 42,000 shares. The insider buyers are also outnumbering the sellers at CarMax and Cars.com, which suggests the entire used car dealership cohort is undervalued and due for a recovery. The bear case. 3 reasons. Number 3. The debt. At the end of the Q1 2023, Carvana had total debt of $8.5 billion, including $6.6 billion in long-term debt, $1.7 billion in short-term revolving debt, and $200 million in long-term debt that's due in the next year. While the stock market is full of speculators driving stocks up and down, the bond market is usually a more serious affair. And right now, the bond market is saying that Carvana is a distressed company that's unlikely to survive this decade. A Carvana bond set to mature in 2030 currently trades at 35 cents on the dollar. Even more telling is a Carvana bond that matures less than 3 months from now that currently trades for 74 cents on the dollar. There's some serious doubt that Carvana will be able to make this payment. Number 2. Slowing revenue growth. There has been a significant slowdown in Carvana's revenue growth over the last year. While COVID provided a boost to its revenue, but the growing inflation and higher interest rates have brought revenue decline over the last several quarters. Number 1. The real profit. There's no doubt that Carvana is moving in the right direction. Gross profit was up in Q1 2023 despite a steep 25% revenue decline, and operating expenses were greatly reduced. But Carvana is not even in the ballpark of turning a real profit, and it still won't be in Q2 according to many analysts. Even with the improvements in margins, interest payments ate up 47% of gross profit. And even with operating expenses down 35% year over year, gross profit remains too small to support this level of spending. Carvana's balance sheet includes total debt of $8.5 billion. Based on Q1, the company will pay over $600 million in interest on that debt this year. Any profitability metric that ignores interest is not a profitability metric at all. If Carvana can't cover interest, it's not profitable. While Carvana is successfully boosting gross profit per vehicle and bringing costs down, making the math work is going to be difficult thanks to the debt weighing the company down.
For now, that's it from us. Hope you enjoyed and learned from this video. Smash that like button and subscribe to receive more videos on memos and write-ups from top investors.